All right, let's talk about Fabrinet. Something really strange happened with their stock recently, and that's what we're going to break down today. They had this incredible earnings report, and the stock just cratered. So what gives?
So here's the big question, right? You've got a company firing on all cylinders. We're talking their best quarter ever, the fastest growth they've seen since they went public. And what happens? The stock takes one of its biggest nosedives. It just doesn't add up. So let's figure out what really happened here.
Okay, so before we can even get to the crazy market reaction, you've got to understand just how good the quarter actually was. Let's dive into the headline numbers.
So first up, revenue. A record-breaking $1.133 billion. And look, this wasn't just them squeaking by expectations. They absolutely crushed it. Wall Street was looking for something around $1.08 billion. This was a massive beat, and it represents a staggering 36% growth compared to last year. Just huge.
And it wasn't just about sales. The bottom line was just as impressive. Their non-GAAP earnings per share hit a record $3.36. Again, way ahead of what Wall Street was expecting, which was more in the ballpark of $3.25.
So when you put it all together like this, you really see the scale of it. They didn't just beat the estimates, they showed this incredible acceleration from the year before. I mean, this is the kind of report that investors usually love, right? You'd expect the stock to take off. And hey, don't just take my word for it. The CEO himself, Shamist Grady, was on the call basically saying this was an excellent quarter. He pointed out they blew past their own guidance and that it was the fastest growth they've had since their IPO. So the message coming from the top, it was crystal clear. Everything is going great.
Okay, so the quarter was amazing. But what about the future? Well, the good news didn't stop there. When they talked about what's coming next, the story was just as bullish. They're seeing this momentum continue.
So for the next quarter, Q3, they're guiding for revenue between $1.15 and $1.2 billion, and earnings somewhere between $3.45 and $3.60 per share. You know, if you take the middle of that range, we're still talking about 35 to 40% growth year over year. This really shows that management believes this wasn't just some one-time fluke. The strength is real and it's sticking around.
So what's driving all this? A huge piece of the puzzle is high-performance computing, or HPC. And get this, revenue from HPC went from just $15 million in the first quarter to $86 million in the second. That's not growth, that's an explosion. And they think this one program could hit a run rate of over $150 million. This is that AI story you hear so much about, playing out in real time.
And if you look even further out, the story gets even better. Fabrinet is setting itself up for the next generation of data centers. They're already starting to make money from these super advanced technologies like co-packaged optics and optical circuit switching. Think of it as like the next-gen plumbing for data centers to make everything faster and more efficient. And they're building out their factories like crazy to get ready for all that demand. So the story looks totally solid, both for right now and for the long haul.
Okay, so let's recap. We have record results, we have amazing guidance, we have a clear path for future growth, everything is pointing up, up, up. You'd think the stock would have just skyrocketed, right? Well, what actually happened is the entire reason we're here today.
And at first, things made sense. Right after the earnings came out in after-hours trading, the stock jumped up over 2%. Totally logical. But then, the next day, the market opened and it was a complete 180. The stock just fell off a cliff, dropping almost 17% at its lowest point. I mean, what a brutal, whiplash-inducing reversal.
So that brings us back to the big question. Why? Why this huge disconnect? How can a fantastic report lead to such a massive sell-off? Well, the answer comes down to one simple but powerful idea: expectations. The stock was, to put it simply, priced for absolute perfection.
And here's the chart that tells the whole story. You have to look at the run-up into this report. Over the past year, Fabrinet's stock was up over 87%. The S&P 500, up about 16%. I mean, it just left the market in the dust. When a stock runs that hot, expectations get pushed to the moon. The market wasn't just hoping for a good quarter, it was demanding an earth-shattering one to justify that price tag. And that's really the heart of it. You had management delivering this message of we're crushing it and the future looks great. But the market, which had already bet on a grand slam, looked at the report and basically said, yeah, that was a home run, but we were expecting you to hit it out of the solar system. The bar was just set impossibly high. Even this incredible performance wasn't enough to clear it.
All right, so that's the why. Now for the what's next. Where does the stock go from here? This brings us to our final segment, the next call.
So after digging into all of this, we're assigning Fabrinet an outperform rating. Now, just to be super clear on what that means, we expect the stock to do better than the overall market over the next year or so.
So how do we see this playing out? Well, a few things. First, we think another earnings beat in Q3 is pretty likely, especially with that HPC momentum they have. Second, for the stock price itself, we expect it to probably chop around for a bit while the dust settles before starting to recover as new catalysts emerge. And third, what are those catalysts? Well, you've got to watch three things. Are they continuing to deliver on that HPC ramp? Are they getting any real, meaningful revenue from those new CPO and OCS technologies? And are they making progress on getting those new factories up and running?
So to wrap it all up into a trade idea, we think the sell-off, which was really about sky-high sentiment and not a problem with the business itself, could be an interesting entry point for someone with a year-long view. The whole thesis here is that the stock will recover as the company just keeps doing what it's doing, executing on its growth plan. And the very next thing to watch, the next earnings report, to see if that incredible HPC growth is for real. And of course, just a reminder, this is not financial advice.